สภาวิชาชีพบัญชีในพระบรมราชูปถัมภ์เราเป็นองค์กรตามพระราชบัญญัติวิชาชีพบัญชีจัดตั้งขึ้นตั้งแต่พุทธศักราช 2547 มีบทบาทสำคัญในการส่งเสริมสนับสนุนพัฒนาและกำกับดูแลผู้ประกอบวิชาชีพบัญชีเพื่อให้การประกอบวิชาชีพบัญชีในประเทศไทยสามารถปฏิบัติงานได้อย่างถูกต้องมีจรรยาบรรณมีคุณภาพตามมาตรฐานสากลตามวิสัยทัศน์เป็นองค์กรที่เสริมสร้างและพัฒนาผู้ประกอบวิชาชีพบัญชีให้เป็นมืออาชีพร่วมสมัยเป็นสากลและมีจรรยาบรรณสภาวิชาชีพบัญชีดำเนินงานโดยยึดหลัก 5 ข้อคือ Quality Trust Integrity Transparency Independence ซึ่งหมายถึงสภาวิชาชีพบัญชีจะต้องดำเนินงานอย่างมีคุณภาพมีความน่าเชื่อถือสุจริตโปร่งใสเป็นอิสระและเป็นวิชาชีพที่ได้รับความไว้วางใจเราส่งเสริมการศึกษาการอบรมและการวิจัยที่เกี่ยวกับวิชาชีพบัญชีเพื่อให้ผู้ประกอบวิชาชีพบัญชีมีความรู้ความชำนาญความสามารถในการพัฒนาตนเองตามการเปลี่ยนแปลงและความต้องการของผู้มีส่วนได้ส่วนเสียเรากำหนดมาตรฐานการรายงานทางการเงินมาตรฐานการสอบบัญชีและมาตรฐานอื่นๆที่เกี่ยวข้องกับวิชาชีพบัญชีเพื่อให้ผู้ประกอบวิชาชีพบัญชีได้ปฏิบัติงานตามมาตรฐานที่ยอมรับทั่วไปเราเผยแพร่และแลกเปลี่ยนความรู้ทางการบัญชีด้านต่างๆอาทิการทำบัญชีการสอบบัญชีการบัญชีบริหารการวางระบบบัญชีการบัญชีภาษีอากรการศึกษาและเทคโนโลยีการบัญชีและด้านอื่นๆแก่ผู้ประกอบวิชาชีพบัญชีและประชาชนทั่วไปเพื่อให้รับรู้และเข้าใจถึงคุณค่าและคุณประโยชน์ของการบัญชีเราส่งเสริมและควบคุมผู้ประกอบวิชาชีพบัญชีให้เกิดการปฏิบัติงานที่ดีไม่ให้การละเมิดจรรยาบรรณที่กำหนดเกิดขึ้นหากมีผู้ใดไม่ปฏิบัติตามจรรยาบรรณเรามีหน้าที่ในการดำเนินการตามข้อกำหนดเพื่อแก้ไขปัญหาที่เกิดขึ้นอย่างทันท่วงทีสภาวิชาชีพบัญชีเรามุ่งมั่นตั้งใจที่จะพัฒนาวิชาชีพบัญชีของประเทศไทยให้เกิดประโยชน์สูงสุดและเป็นส่วนหนึ่งของการพัฒนาประเทศร่วมขับเคลื่อนวิชาชีพบัญชีไทยไปด้วยกัน
When I say accountancy, you think of the numbers. But it's much more than that. To change things for the better, drive prosperity and create opportunity. Who can make the numbers do all that? We're leaders. ACCA accountants understand teamwork and know how to maximize opportunities. We're essential partners in getting businesses to achieve their goals. We're communicators, able to imagine and inspire. If all the world's a stage, you must be able to speak on it. We're pioneers who test boundaries and push frontiers. We challenge people to think ahead and make ethical choices. We love sustainable solutions to today's problems. The future is ours to protect and nurture. We're digital. We harness the power of technology to innovate and push boundaries and be a positive force for good. We're artists, applying original solutions to real-world problems. When misfortune strikes, it's not just money that's needed to rebuild, but an energetic mind and original voice to overcome the odds. We're ambitious. Our accountants know no boundaries and harness the power of diverse cultures to seek out international opportunities. Accounting is the global language of business, and being fluent can take you anywhere. So when I say accountancy, sure, think of the numbers. The number of lives changed, systems improved, business successes, environments saved. Studying to become an ACCA finance professional means to future-proof your passions, your skills, your life for the opportunities of a brighter tomorrow.
Good morning audience around the world who watching TFAC Facebook Live. Welcome to TFAC Facebook Live. Today you are with me, Mr.Thongkoon Sangthammarat, Director of PS Accounting and Committee of ACTAP. Today I have the honor of being your host for today's panel discussion on the topic the Pillar 2 paradigm shift, navigating the global minimum tax for Thai multinationals. This is episode 2, where we will examine the potential implications for multinational enterprise operating in Thailand, along with insight from early adopters from a professional firm's viewpoint. This is a particularly fascinating topic because Thailand has not yet adopted the global minimum tax rule, and understanding how its implementation might impact businesses in Thailand, especially multinational companies with operating in several countries, requires special attention to the principle of the global minimum tax rules. In the episode 2, we will continue from the last episode, which discussed the fundamentals of the global minimum tax rules and explains its principles. Today, we will dive deeper into the practical application possibility within Thailand, including direct enterprise excellence from international experts on the actual implementation of the global minimum tax rules. We are pleased to have 3 experienced speakers with us today. Is possessing direct experience with global minimum tax rule. They will share their insights and experience with all of us today. Our first speaker is Kun Niorn Yukolthong, Tax Director at Deloitte Touche Tohmatsu Jaiyos Advisory Company Limited. Our second speaker is Mr. Jason Piper, Head of Tax and Business Law, Policy and Insights at ACCA. And last but not least, we have Mr. Hooi Beng Tan, Deputy Managing Director and Southeast Asia International Tax Leader at Deloitte. In episode 2, we will divide our discussion into 2 sessions. The first session will focus on the consideration for the practical application of the global minimum tax rule in Thailand, and whether it is feasible to implement here. The second session will feature a panel discussion among our 3 expert speakers on applying the global minimum tax rule in real-world scenarios and the various impacts that arise. At this point, I believe many of you are eager to know what the thought process and directions will be for the practical application of the global minimum tax rule in Thailand. So, let me invite our first speaker. Please welcome Kun Niorn Yukolthong, Tax Director at Deloitte Touche Tohmatsu Jaiyos Advisory Company Limited. Please welcome.
Thank you, Kun Thongkoon, for introductions, and good afternoon, everyone, and sawadee ka. And it is truly an honor to be here today to discuss a significant development in the global taxation landscape, which is the global minimum tax framework under the OECD Pillar 2 initiative. To briefly recap for those who may not have been part of EP.1, The Pillar 2 or GMT rules introduced by the OECD in 2021 represent a landmark initiative in addressing long outstanding global concern about fair taxation and profit shifting. The framework established a standardized approach to implement a global minimum tax rate of 15% across all jurisdictions where the multinational enterprises or MNE operate, ensuring that the large M&E group contribute their fair share to the economy of the location where they generate value regardless of the local tax rate or incentive. If its effective rate or ETR falls below 15%, a top-up tax will apply to cross the gap and bring the ETR of that jurisdiction up to the minimum threshold of 15%. The Pillar 2 or GMT rules apply to large MNEs operating business in more than one jurisdiction, with the group consolidated revenue exceeding 750 million euro or approximately 28 billion Thai baht in at least 2 out of the last 4 preceding fiscal year based on their consolidated group revenue. The framework is designed to mitigate the advantages previously exploited through tax haven and low tax jurisdiction in the past, and its official implementation, which began this year in 2024 across numerous jurisdictions, marks a crucial turning point in the pursuit of a more equitable and sustainable international tax system. And starting this year, 2024, many countries, especially in European countries, as well as Korea, Japan, Vietnam in Asia, have officially implemented the Pillar 2 or GMT rules. And next year, in 2025, jurisdictions like Hong Kong, Singapore, Malaysia, and Thailand are expected to follow. In essence, this global initiative reflect a significant transformation in the international tax landscape. It demonstrates a strong commitment by governments worldwide to establish a unified and fair taxation system around the world. Moving to understand the ETR for Pillar 2, which is not considered on a per entity basis, as is typically done for local tax filing. The jurisdictional blending approach is a key of Pillar 2, and under this approach, the ETR is determined on a jurisdictional basis by dividing the total covered taxes paid by all entities within a jurisdiction by the gross net income in that jurisdiction. Entities within the scope of Pillar 2 are referred to as constituent entities, or simply the CE. And the ETR is firstly calculated for each CE within the jurisdiction, and then ETRs for all the CE are blended to derive the jurisdictional ETR for Pillar 2. And by adopting the jurisdictional blending approach, Pillar 2 takes a broader perspective, focusing on the overall tax position within each jurisdiction. This approach offers a more comprehensive assessment of tax outcome, ensuring a fairer and more accurate alignment of the tax liability globally. And in today's discussion, we won't go into detail of how jurisdictional ETR is calculated, as it requires numerous adjustments, both mandatory and election adjustments, to determine the ETR under the group rules. And as you can see on the screen right now, the jurisdictional ETR is calculated by dividing amount A, which represents the adjusted cover tax for all in-scope entities within jurisdiction, by amount B, which is the net group income for all entities in the same jurisdiction. And in brief, the calculation follows the matching concept. And this means that if any item are excluded from the denominator, which is amount B, the related tax effect must also be excluded from the numerator, which is amount A. This ensures a standardized ETR is derived for the purpose of the Pillar 2 rules in all jurisdictions. The formula here is conceptually straightforward. but become complex in practice due to the challenges of calculating amount A and amount B, whereby the difficulty arises primarily from differences in accounting and taxation system across the country. And next, to help you gain a better understanding of the jurisdictional branding approach, let's take a closer look at how it's functions under the Pillar 2 framework. In this slide, ACO is the Thai ultimate parent entity or UPE of the group. And assuming this group also operates in Singapore and Malaysia and fall within the scope of Pillar 2. In Singapore, as you can see, there are two entities, BCO and CCO. Assuming the ETR calculated under the Pillar 2 rules of BCO is 10% and for CCO is 40%. This doesn't mean that a top-up tax will apply to BCO because its ETR is below 15%. Pillar 2 doesn't operate in that way. Instead, the rule requires jurisdictional blending approach where the ETR of both entities are combined and end up with jurisdictional ETR for Singapore at 25%, which exceeds the global minimum tax threshold of 15%. And as a result, no top-up tax is required for Singapore. And moving to Malaysia, there are two entities, DCO and ECO, with the ETRs of 15% and 5% respectively. Similar to Singapore, we cannot conclude that DCO has already met the threshold and only ECO is subject to top-up tax. Pillar 2 again does not function in that way. We need to blend the ETRs of both entities and end up with a jurisdictional ETR of 10% in Malaysia, which is below the minimum threshold of 15%. As a result, a top-up tax is triggered to bridge the gap and bring the jurisdictional ETR of Malaysia up to 15% in order to meet the global minimum tax requirement under the group rules. So now the key question is, how is this top-up tax collected? And that's where the charging mechanism in the red box on the right-hand side of your screen come into play. This mechanism includes qualified domestic minimum top-up tax or QDMTT, income exclusion rules or IIR, and under tax payment rules or UTPR, which will be briefly discussed next. And again, this jurisdictional blending approach ensures fairness by capturing the overall tax burden within a country rather than focusing on individual entity, which might otherwise distort the result. So moving next, once the jurisdictional ETR is derived, a low tax jurisdiction and the groups are identified, then three means will come into play to address any shortfall. To do operate in an interlocking manner to ensure that any tax gap of the group is effectively addressed and filled under the group rules. So first start with the Qualified Domestic Minimum Top-Up Tax or QDMTT. The QDMTT is a local rule that requires jurisdiction to impose its own minimum tax to close the gap between the local ETR and the 15% minimum threshold. The QDMTT rules ensure that revenue generated from the top-up tax remain within the low tax jurisdiction itself. However, not all countries have implemented this rule because the QDMTT is optional for jurisdiction to adopt. Jurisdictions that do not implement the QDMTT rules would lose potential tax revenue. A top-up tax will still be collected by other jurisdictions under the Pillar 2 anyway. But if the QDMTT is applied in jurisdiction, so it takes precedence over the subsequent rules, and no further top-up tax may be required under income exclusion rules or under tax payment rule, which will be discussed next. And next, we move to the income exclusion rule, the main rule of Pillar 2, which serves as the main rule. If the low tax jurisdiction does not implement the QDMTT, or if the QDMTT does not fully cover the tax shortfall, then IIR come into play. The IIR apply a top-down approach, starting with the ultimate parent entity or UPE in short. If the UPE cannot fully apply the IIR or the UPE's jurisdiction has not enacted the rule yet, the IIR cascade down to the next level of the intermediate parent entities to ensure that group compensate for the low tax income in the jurisdiction where they operate. And then move to the under-tax payment rule or UTPR, which acts as a safeguard or backstop rule within the Pillar 2 framework. The UTPR applies when the IIR does not fully capture the top-up tax at the level of ultimate parent entity or UPE. The situation may happen because the jurisdiction of the UPE has not yet enacted the rule. In such case, the UTPR step in to allocate the remaining top-up tax among other jurisdictions where the MNE operate. This rule ensures that countries where the MNE has a significant presence can impose additional tax to bring the group overall ETR up to the required minimum threshold at 15%. And the last one here is the subject to tax rule or STTR. The STTR rules enable the source countries to impose a treaty-based tax rule on certain intergroup payments such as royalty, interest, or service fee to not less than 9%. The STTR is designed to give the source countries, the jurisdiction where economic activity occurs, the right to impose minimum level of taxation which the OECD has set at nominal rate at 9%. If the tax rate in the source country below 9%, then the source country has the right to impose additional tax on the gross payment, ensuring it is effectively taxed at or above the minimum threshold of the intra-group transaction set by the OECD. So these are the mechanism of the Pillar 2 rules in brief, and Thailand is preparing to implement all the key components of the Pillar 2 framework, which is expected to take effect next year in 2025. And next, to help you better understand how each rule applies, I'll briefly explain the application of the top-up tax charging mechanism under the Pillar 2 framework. This slide show on your screen right now outline the three scenarios for the imposition of top-up tax. Each scenario is influenced by how the key rules are implemented within jurisdiction, highlighting differences in government policy and implementation timeline. So let me quickly guide you through each column to explain how this scenario play out. Start with the first column, the first scenario on the left-hand side of your screen now. We see how jurisdiction can apply the domestic top-up tax or QDMTT to address low tax income locally. In this structure, ACO is the UPE located in country A. ACO holds interest in BCO operating in country B and CCO operating in country C. And after deriving the jurisdictional ETR, country C is identified as a low tax jurisdiction, such that a top-up tax is required to bridge the ETR, to bring the ETR in country C up to the global minimum tax rate of 15%. And as you can see, both country A and country B also implemented the IIR and UTPR rules. However, instead of allowing country A or country B to impose the top-up tax through the IIR in country A, under the top-down approach, but country C here in the picture implement its own qualified domestic minimum top-up tax or QDMTT. And by doing so, country C ensure that the top-up tax is levied domestically. So additional tax revenue stay within country C rather than being allocated and collected by other jurisdictions, meaning that country C retain full control over the collection of the top-up tax within its jurisdiction by QDMTT rule and alignment with the broad rules. And next, in the middle column, highlight the operation of income exclusion rule or IIR under the top-down approach. Using the same holding structure we just discussed, so let's consider country C, which is identified as a low tax jurisdiction, but has not implemented the QD-MTT rule, such that country C does not retain the taxing right over the top-up tax within jurisdiction. And given this situation, country A as the jurisdiction of UPE and the country that has implemented the IIR assume responsibility to collect the top-up tax in country C under the top-down approach, enforcing the IIR to address the low tax income in country C. And also, I just would like to highlight that if country A does not implement the IIR at that time, other jurisdictions down the ownership chain that have implemented the IIR, such as country B in this example, would step in to collect the top-up tax on the income in country C. And the rule ensures that responsibility for addressing low tax income flow from the top, starting with the parent company jurisdiction down to the ownership chain of the group. And finally, on the right-hand side column of your screen right now, demonstrate the UTPR, which serves as a backstop rule when the IIR and QD-MTT are not implemented. And in this structure, country B in the middle is identified as a low tax jurisdiction. Here, neither country A nor country B has implemented the IIR or QD-MTT. As a result, country C at the bottom of the ownership chain can step in and apply the UTPR as a fallback mechanism to ensure that income in country B is taxed at the minimum rate by country C under the UTPR rules. Together, these all mechanisms work cohesively to ensure a level of playing field for all jurisdictions at the minimum requirement of 15% under the group rule. And while discussing the need to calculate the ETR and apply the charging mechanism of the top-up tax that we just covered, I would like to highlight that the safe harbor rule under the Pillar 2 is also crucial, because this is the transitional measure which are designed to reduce administrative burdens during the early stage of implementation. And they allow certain jurisdictions to bypass the full ETR calculation if specific criteria are met, deeming the ETR to be zero for top-up tax purpose during the transitional period. And the safe harbor rules offer temporary relief for a qualified jurisdiction and are expected to apply for a limited period of 3 years after the Pillar 2 takes effect. For those qualified jurisdictions, this removes the needs for detailed group or ETR calculation during the transitional period, significantly simplifying the process of the group. And while we won't go into detail of the safe harbor rules today, I encourage you to keep in mind the important provision of the safe harbor transitional rule, as it may offer significant benefit to the company during the transitional period. And here is a brief overview of the charging mechanism under the Pillar 2 framework. However, in practice, its application is far more complex due to the complicated group structure of M&Es, whereby the structure often spans multiple jurisdictions and may involve scenarios like partially owned parent entities or minority-owned constituent entity, Deloitte entity, and other unique cases. Each of the situations is subject to specific rule and condition, requiring a careful consideration when calculating the ETR and allocating the top-up tax appropriately. So next is the latest development of the PMT or Pillar 2 rules in Thailand. So what happened in the past in Thailand, as I believe that everyone know that March last year, the Thai cabinet approved the measure to support the implementation of GMT rule in Thailand in order to align with the global tax reform under the Pillar 2. And then a few months later, in May 2023, the Thailand Board of Investment, or BOI, introduced optional tax reduction to reduce the CIT from 20% to 10% with the extension period of tax incentive cap at 10 years. And then early this year, March 2024, draft legislation of Pillar 2 was released for public consultation. And recently, September this year, Thailand also signed a letter of intent to become a party to the STTR-MLI, which allowed the South country to impose a treaty-based tax on certain intergroup payments such as royalty, interest, and service fee to not less than 9%. It will be important to continue monitoring development in this area as well. And last week, on December 11, the cabinet just approved an emergency decree related to OECD Pillar 2 Global Minimum Tax Framework, which is expected to take effect in 2025 as planned. So this development demonstrates Thailand's proactive step to prepare for the Pillar 2 through implementation next year for sure. So then I would like to briefly highlight on the key component of the draft Pillar 2 of Thailand at the moment. Right now, the draft law will apply to both Thai headquarter M&E groups and foreign M&E groups operating in Thailand. The draft would mostly follow the GROP rule or OECD rule. And based on the draft announced in March this year, the key consideration of the draft include tax charging mechanism, which are expected to cover all the rules, QDMTT, IIR, UTPR, which are the three cornerstones of the GMT framework. And in terms of notifications and returns, Thai entity will be required to electronically file a notification, group information returns, and top-up tax return within 15 months after the fiscal year end, with an extension to 18 months in the first year of implementation. In terms of compliance and obligation, it's also crucial as well, because an incorrect filing will result in a penalty of up to 100% of the top-up tax shortfall, while the failure to file could lead to 200% penalty, including additional 1.5% monthly surcharge on the top-up tax shortfall. So here you can see Thailand draft law will implement the OECD, will align on the OECD framework aimed at ensuring that the M&E pay a minimum effective tax rate of 15%. And this initiative aligns Thailand with the global development to address tax-based erosion and profit shifting along the way. So looking ahead, here's what to expect. In terms of timeline, absolutely the legislation is expected to be finalized and enacted in 2025 based on the cabinet resolution to approve the emergency decree last week. So in scope, M&E should proactively develop appropriate action plans to ensure ongoing compliance. These steps include conducting impact assessment, performing safe harbor tests, preparing the top-up tax simulation, and establish readiness for data collection and filing obligation on a forward-looking basis. All right, so I believe that this discussion covered the key components and consideration of the Pillar 2 framework, which will significantly impact both large multinational enterprise headquartered in Thailand with foreign operation, as well as foreign headquarter M&E operating in Thailand. And now I would like to hand over the floor to Kun Thongkoon, who will lead the discussion on the experience to be shared by the other panelists, offering a practical insight from countries that have already implemented the rule. คุณทองคูณ over to you ค่ะ
Thank you very much คุณนิออนยุคนทง Tax Director at Deloitte Touche Tohmatsu Jaiyos Advisory Company Limited for sharing your experience with us today. Your example on each model are easy understanding, and I wish audience will get a lot of learning on your session. Thank you very much. We look forward to having you in the next session as well, where you will continue to share insight on the real-world applications. Okay, let's go to the next session. We will proceed to the session 2, a panel discussion on applying the global minimum tax rule in real business. Please welcome our three speakers. The first, Mr. Jason Piper, Head of Tax and Business Law, Policy and Insights, ACCA. And Mr. Hooi Beng Tan, Deputy Managing Director and Southeast Asia International Tax Leader at Deloitte. And once again, คุณนิออนยุคนทง Tax Director at Deloitte Touche Tohmatsu Jaiyos Advisory Company Limited. Okay, when we are ready, let's jump into the first topic. Could you share key lessons and practical insights from countries that have already implemented the global tax framework? What challenges did they encounter, and how were they addressed? Mr. Jason, please start first.
Hello, thank you for allowing me to join you today. It's an honor to be here and join this discussion on what is an important and fundamental change to the way businesses are taxed, not just in Thailand, but around the world. And as Kun Yukolthong has explained, we have around 20 countries which have already fully implemented this framework for tax changes. And that includes many in the Asia Pacific region, and also, of course, UK and the EU directive on global minimum tax. We've obviously, not had any final returns submitted yet, but businesses are having to prepare, and we have some evidence already. There's a lot of anecdote, a lot of discussion behind the scenes, but also some official statistics. People have done research to find out what are businesses doing to respond, and what are tax authorities doing to respond. And we have, so that there's been a survey of, for example, businesses in the UK. The primary thing they've discovered, as you will have gathered from the presentation we just had, these are complex changes, and of course we have the safe harbour, the transitional safe harbour to deal with as well, which is not the same as the final return will be, albeit that it should be simpler. But the actual impact on taxes is not expected to be very high. A survey of, I think it was 100 companies in the EU who are affected by the tax, all within scope, only 10% estimated they would have any change in their actual level of tax paid, an adjustment in line with the OECD predictions. Similarly in the UK, there are a number of quotes that perhaps put it in the words of the people who are affected themselves. So we don't think it will have a material impact because most of the countries we operate in are not likely to be affected. Or from someone in the banking sector, it will have an impact on us because we do have a subsidiary in a low tax jurisdiction, but it is only one, and it's going to be a very low payment because the profits there are so low. And also the particular jurisdiction I'm talking about is going to raise its tax rate within a couple of years. So it won't be an issue by then anyway. So in terms of the tax, most businesses are expecting no effect or negligible effect on the amount of actual tax they pay. So what are people seeing? Well, they're seeing a significant impact in terms of the administrative burden to comply with this. Again, a few quotes. It's taking up an awful lot of time just to understand the rules. I think we can all sympathise with that view. Even though the first returns aren't due until 2026, we have to think about that process now. It is a resource strain. We meet every couple of weeks to talk about it and plan for it. And finally, which I think echoes the view of a lot of businesses, there's not really any question that we'll all pay more tax anywhere, but it will cost us an awful lot of money to prove that. And I think that's the case for 9 out of 10 businesses. It's a question of proving it, and you're costing us £100,000 a year to be able to do that. And then there's the reporting element every single year. So why is it that we've got this huge administrative burden? And so there are two elements. We've already discussed the final globe return, which is, I think, 28-page return in itself, but requires a huge number of adjustments and things to think about. And I've seen estimates from some advisors that they think only 50% of the data points that will be needed for a globe return are currently captured. So businesses are having to look forward to when this return will be in place, and they need to ensure they've got the systems in place and the data return, the data capture to complete the return. And that's causing some businesses to look at their fundamental underlying process for tax compliance. There's been a shift perhaps in some businesses to move to a decentralized model, moving things around so that you no longer have a single head tax office. With the need to understand what's going on in every jurisdiction, some businesses are having to reverse that. The sample size in the UK was small, but around 3/4 of the businesses affected said they were going to alter their corporate structure of the group, so change direct ownership of subsidiaries, for example, to respond to the taxation. Another third say that they're actually intending to move business activities to jurisdictions where they already have significant economic activity. So we've got some changes to the underlying structure of how firms do business. In terms of the reporting, I'm conscious of time, so try to keep moving a little bit. There are a lot of differences between this transitional safe harbour rule, which we have mentioned, and the final globe return. It's been joked that tax advisors love transitional rules because you get a whole extra set of advisory fees. I'm not sure that's necessarily fair because, I think most advisors would rather be helping people improve their business and comply with taxes that are going to have an impact. We're not seeing necessarily an impact here, but there's large numbers of things which will be adjusted in the globe return, which we can ignore for the safe harbour calculations. So we've got to put in place, firstly, the safe harbour calculation. Even that is not as simple as it perhaps might be. Businesses are needing to check out a number of issues. For example, transfer pricing adjustments, which are often used in your conventional country-by-country reporting. These have to be stripped back out for the safe harbour return. So that's something businesses are needing to deal with. In terms of where we go from here, of course, that safe harbour is only transitional. At the moment, we only have it for 3 years. We're hoping there will be a permanent safe harbour, but we don't know yet. We'll perhaps discuss that a little bit more later on. But I think that the main issue businesses are finding is not where will we find the cash to pay this extra tax. It's how can we find the resource to manage the transitional rules, and then in the long term, the final implementation itself. and we'll discuss in more detail, I'm sure, some of the implications for that. But I think, as I say, that's, in summary, there's broad support for the idea that businesses should pay this sort of fair amount of tax across the globe. The practical implementation, we were always concerned it would be very complex, and it seems that it may actually be exceeding even those expectations, both in the minds of business and even tax authorities. We'll talk a little bit more about the tax authorities later. But without wanting to take any more of your time, I'll hand over for the other panelists to provide their input. Thank you.
Yeah, thank you very much, Mr. Jason. You said just to make the comprehensive understanding about the regulation and impacts on each business taxation, especially safe harbor return and calculation. Thank you very much, Mr. Jason. I think Mr. Hooi Beng Tan may have something to share further. On your turn, Mr. Hooi Beng Tan.
Sure, Kun Thongkoon, and thanks, Jason, for the insightful input on that. In terms of what the real challenges and practical insights that one could, see for those countries that implemented Pillar 2 Global Minimum Tax. So just to recap, right? This Pillar 2 Global Minimum Tax applies to two types of taxpayers, right? Yeah, one is what we call outbound situations, right? So that's example, the Thai listed company, for example, having various operations around the world and in Thailand as well, right? So that is what we call outbound situations. And then the second situation will be the inbound situations, right? For example, the US multinationals, the UK multinationals having parent co based in UK, for example, having a subsidiaries in Thailand. That's the inbound situations, right? So you have outbound, inbound situations, and obviously, these two taxpayers are being impacted. Like what Jason mentioned earlier, probably not many MNEs may have a top-up tax unless, if you're enjoying tax holiday in certain countries, then you may have an issue. Otherwise, may not necessarily have a top-up tax in most situations, but the administrative, the compliance obligations are really massive, right? So arising from that, there'll be various challenges. Maybe I'll share with you a couple of challenges that I've really experienced before. Over the last 24 months, I've been working with many multinationals in Malaysia and Southeast Asia, including some of the Thailand MNEs. These are the real challenges that I'm going to share with you, right? Challenge number one really here is that within the client itself, right, within the multinational itself, the question really is which division should be leading this Pillar 2 work in the particular organization, right? Obviously, Global Minimum Tax, Pillar 2, as the name suggests, right, is a tax, right? And obviously, all eyes will be on the head of tax, the tax team, the central tax team. But we also know then, right, Pillar 2 Global Minimum Tax is the only international tax law that is accounting driven, right? So never before any international tax law based on accounting, right? Who cares about accounting in the past, right? Tax is tax, tax is a law, right? But Pillar 2, unfortunately or fortunately, is really very much based on accounting rules, deferred tax, for example, and therefore if you're an accountant, you're good in all the figures, you're very good in accounting rules, then you have a bit of advantage on Pillar 2 vis-a-vis, tax lawyers that, who are not really familiar with figures. That may be some challenge to them. Now, the issue that I was saying is that then when in the organization itself, right, who is to lead Pillar 2 work? Well, people will be looking at head of tax, and head of tax will then be saying that, look, this is not the typical traditional tax regime, right? It's accounting driven. So he will be looking at the finance controller, right? And then in the end, nobody wants to take up this job because this is extra burden, right, on top of what you have. So this is one single largest challenge when I've talked to MNEs. This is the problem. So in the end, right, to make this work in the MNE, a steering co, right, must be set up and to be checked by the CFO. And then when CFO says, yeah, we got to do it together, the tax team together, the accounting team with the consolidation team will work together, with the IT team work together to make sure, MNE can, implement this properly and be in 100% compliance. So this is one of the key challenges. Whose responsibility is that, right? Other challenges includes, I think Jason mentioned a little bit earlier, interpretation of the rules. These rules are super complex. Ladies and gentlemen, it's super complex. it is clear that Pillar 2 is the single largest tax reform in the history of mankind. It's the largest tax reform. Involves so many countries, involve a complex law, overly complex. Sometimes people say it's not meant for human being. It's really complex. When you read the law, you read the model rules, you read the commentary, right? You read the administrative guidance 1 to 4 with all the examples, right? It runs to thousands of pages, right? So it's really complex. So that's real big challenge for everyone, right? For the tax authorities, for practitioners like myself and Niorn, for the MNEs itself, right? It's a big challenge. Now, other challenge include separate data points. There are many data points that are required for Pillar 2. What I wanted to say is this. This is a very important one, right? Now, many countries, you by now you probably will be familiar with the terms of QDMTT, Qualified Domestic Minimum Top-Up Tax. Every country, including Thailand, Malaysia, UK, wherever you are likely to introduce and have introduced Qualified Domestic Minimum Top-Up Tax anyway, right? Except for Korea and Japan, the rest are doing QDMTT. Now, let's take a very example. Real life challenge in this example is that you have a Thailand ultimate parent based in Bangkok, right? For example, having a subsidiaries in Malaysia, having a subsidiaries in Singapore, and then having a subsidiaries in the UK. Okay, so you're operating in Malaysia, UK, and Malaysia, UK, and Singapore, right? Apart from Thailand itself, right? So now Malaysia's QDMTT, right, is based on local accounting standard in Malaysia. Okay, likewise in Singapore, Singapore's QDMTT is based on local accounting standard in Singapore, whereas in the UK itself, UK's QDMTT says this. It says UK's QDMTT is based on foreign UP accounting standard. In this case, it's Thailand accounting standard because your UP is in Thailand. So you can imagine a group in Thailand, right, outbound group, right, having various constituent entities, various countries, different countries using different accounting standard to calculate the QDMTT. It means when you do the mapping itself, right, you have various mapping. One, what QDMTT for UK is based on UP accounting standard, Malaysia is based on Malaysian accounting standard, so on and so forth. So my point here is that you have various data points and various mapping. This leads to a very important question, whether should you be doing automation right away, or you want to allow the QDMTT of the world, the rules, to stabilize before you start to do the mapping for automation. You can imagine, right, you have to do mapping after another mapping. So I think the key point here is two separate accounting data will be really a big challenge, right? And then other challenges includes monitoring global development. You need to know, if you operate in 20 countries, you need to know when the countries enact a law, when you need to do the registration. For example, Belgium came out with the registration law. It's very complex. In the last few months ago, very complex. And then the next registration, if you're operating in Vietnam, right, the deadline is 31st January 2025. If you're operating in Germany, it's 28 February 2025. So there are many deadlines, registration, notifications, so on and so forth. So a global monitoring, a tight monitoring is very key, right? So and then of course other challenges is that, as I mentioned earlier, you imagine you have a tax holiday in, let's say Singapore, okay, a UPE in Thailand, right, have a subsidiary in Singapore enjoying global traders program, for example, 5% Singapore tax, corporate tax, vis-a-vis the normal corporate tax at 17%. Potentially, there's going to be a top-up tax in Singapore, for example, if you're enjoying global traders program and only have one entity there. So, in short, one of the challenges is to maneuver. How do you want to deal with tax holiday moving forward, right? How do you want to deal with tax holiday moving forward? Because there's going to be a top-up tax of 15%. That kind of like negate the efficacy, right, of the tax incentive. So something that all have to be, we all need to consider. And one credit must be given to the Thai government. Thai government, right, is one of the earliest one, right? Will make an announcement on how they want to deal with tax incentive. I think Niorn has mentioned earlier the BOI incentive. There's a bit of revamp and options for the MNE. So that's credit should be given to the Thai government for coming out with something to address the issue of Pillar 2 on tax incentive. So these are some of the challenges. Yeah, Thongkoon. Yeah.
Yes, thank you very much, Mr. Hooi Beng Tan. Your key point is that Pillar 2 is also based on accounting rule. Clients need to set the steering team to list those regulations. And I get this. Your data points, various data points and mapping in many countries, and they based on the different local accounting standard to calculate QDNTT, and monitoring global development and how to deal with tax incentive. Thank you very much, Mr. Hooi Beng Tan. Okay, let's go to the next question. To our audience, during this time, if you have any question, please feel free to send in our comment on the Facebook. I will pick up and our team will pick up to speaker for answering. Okay, wow. Let's go to the second topic. What are the essential tax service providers should consider when transitioning to the new global tax requirements? Can you provide examples of practical steps firms can take to ensure compliance and efficiency? I think Mr. Hooi Beng Tan will have many things to share on this topic. Please go on.
Sure. Thanks again, Yukolthong. Yeah. So when obviously service provider are firms like mine and all the large firm who does global minimum tax work. So yeah, it's a big change, right? It's really a big change. And what are the essential changes that we, the larger firm, right, especially the big four, need to embrace and to make sure, you know, we as a global tax advisor are in a good position to really to help the client. First of all, based on my experience together in Niorn over the last 36 months, 6 months to 36 months, there are various things that we were doing to prepare ourselves. I mean, first of all, right, my own experience tells me I have more than 20 partners in my Kuala Lumpur office example. A number of them are not, when people look at the rules, it runs into thousands of pages. No one's, where possible, people will try to avoid that, right? I mean, it's a very difficult topic. People rather do normal corporate tax, no tax incentive work, VAT work, transfer pricing, M&A, so on and so forth, right? And then people say, well, let's not try to get into global minimum tax because it's the investment time is enormous, right? So, but for any firms that want to be in a good position to assist the client, it need to have a dedicated team, right? So these are one of the important changes. A dedicated team comprises of various team members, do a bit of investment time over the last 24 months to 36 months, get ourselves ready from the technical aspect, working closely with the transfer pricing team within the professional firms. Why you need to work with closely the transfer pricing team? Do remember, I think Jason also mentioned, Niorn also mentioned about the safe harbor rules, the CBCR safe harbor rules. That is quite important rules for 3 years. So you really need to work with the PP team within the firm to ensure the data that is used for CBCR will also be able to be used for the transition safe harbor. So that's important. And we as a firm, Deloitte, Niorn and I, we are obviously from the same firm. We are in the global Pillar 2 coordination team. We got to ensure that all of us here are properly equipped from the technical aspect. Because the rules are complex, so we from time to time, on a weekly basis, on a monthly basis, we do have our internal global meetings, to discuss about the latest development on Pillar 2, the technical aspect. A lot of ambiguity. Unfortunately, there's a lot of ambiguity in the rules itself. That's why you have administrative guidance 1, 2, 3, 4, and more to come actually, right? So it simply tells you it's really complex. So you need to work closely to build a team, to have a proper team. And only then you can, really serve the client well. And it goes without saying that one important part is that for the large firm who serve multinationals, Pillar 2 must also have a global Pillar 2 compliance solution for the client, because in the end the client, you know, will be saying that, hey, look, Hooi Beng, you know, Niorn, you need to support me in global tax compliance for Pillar 2 for the entire 30 countries, for example. So clearly some methodology, some solution should be in place, which we do have that. So these are the things that we need to get ourselves ready before you can serve the client. As I said, you know, human's nature is whenever possible, you know, you try to do simple things, try to avoid doing complex things. Unfortunately, Pillar 2 is super complex. We have no choice to face that, but it has been a journey. So yeah, in that sense, various preparation has been done to prepare ourselves for that. Yeah, Kun Thongkoon. Yeah.
Yes, thank you very much, Mr. Hooi Beng Tan. As a professional firm should build a strong team to tackle the challenge for our clients and have global solution for our clients. I agree with you. Global minimum tax law is very super complicated. But I think it's for the many user and audience will get learning in the further. Okay, let's go to the next question. How important is effective communication and collaboration between firms and their clients, as well as with tax authorities? When implementing these changes, what strategy has been successful in fostering this cooperation? I think Mr. Hooi Beng Tan may take a little bit break. Let's go to Mr. Jason. Please start first.
Jason, you're muted, Jason.
Mr. Jason. Okay.
Apologies. But thank you for that introduction. And I think in terms of communication and collaboration, it should be obvious from what Hooi Beng Tan has said that you have to communicate. It is so complex that not keeping lines of communication open is a recipe for disaster. And we heard earlier about the penalties that can be imposed all around the place for not complying properly. So is communication and collaboration between firms and their clients important? Absolutely. And understanding the detail of the systems to keep the additional cost burden of the administration down is going to be another very important feature. Also, discussion with the tax authorities, communicating with them. I think it's absolutely, a fundamental point. As we said, is these rules are based on accounting entries, and accounting entries that start with some, a form of consolidation and aggregation. A lot of this is concepts which are going to be completely alien to tax authorities and to the individuals working on them in the tax administrations. So I think there's some work to be done there to ensure that the advisors and the taxpayers are having the right conversations with the right people in the tax authorities and in language that they can understand. And to be sure that they're presenting, why these new, adjustments maybe look different, what the new approach is, and how this functions. How can you help to make sure these conversations are fruitful and productive? And none of this is rocket science, although these are very complex changes and the scale of it is unprecedented. The underlying challenge is the same. We want to get businesses in the position where they're making the right returns, paying the correct amount of tax. Ultimately, the tax authorities should have the same goal, so we can focus on that shared goal. The complexities of the GROBE return, the importance of consistency of administration, discussing that with the tax authorities. Possibly one of the biggest wins that we could get would be to have a permanent safe harbour, because so many businesses won't be affected long term in terms of their actual tax return. If we can develop a safe harbour position, which actually is a genuine simplification over the globe return, we know it's maybe going to be a little bit more complex than what businesses are doing at the moment. But that is something to raise in discussions and to be focused on, and in discussions with the OECD as well, to try and get some central rules out from there. Of course, the challenges we're likely to face a degree of scepticism from the tax authorities. I mean, we know from discussions with them that they're aware of the complexities, they're sympathetic to it, and they would be interested in simplification if we can manage it. But at the same time, you know, understandably, there's perhaps a degree of scepticism from the tax authorities about the safe harbours, given that there have been so many examples in the past of attempts being made to subvert a safe harbour when it's put in place. So I suppose, you know, transparency and accountability are going to be important parts of, you know, having those conversations and demonstrating that we're coming at this with a joint shared goal of getting the tax returns right, but at the minimum cost overall. So I think that's the key message, is focus on the shared goals and understand that some of the language has changed. We're basing these conversations on slightly different concepts and different processes to what we've ever had before. So there's a journey together for both the tax authorities and businesses and their advisors to settle into this new reality of a global tax rather than just country by country.
Okay. Thank you very much, Mr. Jason. Your key point is that communication should be obvious due to it being complex. Understanding the details of the data system should be a fundamental step that can save the company's cost. And communication between companies and revenue department is also crucial, as well as having tax advisor to provide guidance so that the communication between tax authority will be fruitful and beneficial. Thank you very much, Mr. Jason. Let's go to Kun Niorn. Would you like to add anything?
Yes, thank you, Kun Thongkoon. And this is a very good question. And as you may know, as the Pillar 2 rules are complex and affect businesses across multiple jurisdictions, so a coordinated approach involving all stakeholders is crucial to ensure compliance and minimize disruption. So clear communication is very important for helping stakeholders understand the implications of the new rules, and while collaboration plays a key role in accelerating readiness and streamlining implementation processes. And from a professional firm perspective, proactive engagement with the client, tax authority, and all stakeholders within the group is key to ensure alignment from the outset. And additionally, education through workshops along the way plays a crucial role in equipping both clients and internal teams to navigate the complex of the Pillar 2 and working together in overcome the new changes. Initiating discussion early, well before the rule take effect, gives all the parties the opportunity to prepare truly. And as a professional firm, we can provide industry-specific advice tailored to each client's unique circumstances, ensuring readiness for these upcoming changes. And in practice, many in-scope M&E are proactively conducting potential impact assessment upfront before the rules come into effect. This allows them to evaluate the group's position in each jurisdiction, providing guidance on how the rules will impact their operations and identifying which jurisdiction may need to account for the group top-up tax obligation. And I think even in Thailand right now, where the rule have not yet been enacted, this does not mean that the country will not impact it this year. Discussed regarding the imposition of top-up tax, if any country within the group has already implemented Pillar 2 rules, Thailand will still be affected by the rules requiring the calculation of ETR unless the safe harbor transitional rule is met, and then the application of top-up tax, if applicable, still be relevant. And finally, leveraging the technology is crucial strategy as well. Tools that enable the real-time collaboration, data collection, sharing, and tracking the compliance progress make it easier to address challenges promptly and efficiently. So as a professional firm, we believe in and are confident about our tools and technical expertise around the world to support clients in navigating this transition smoothly and efficiently. So that is the perspective in response to your question from professional firms' point of view.
Thank you very much, Kun Niorn. Now we have some questions that are from audience. I will pick up for asking at the end of session. And thank you again for your sharing, Kun Niorn. Go to the next questions. With different international tax elements in play, what options can firms offer to their clients to navigate this complexity? How can they help clients choose the most appropriate approach? Okay, I think this question, Mr. Hooi Beng Tan will have anything to share. Please go first.
Thanks, Kun Thongkoon. So this is a very important question as well. As I think from the very beginning, all of us agree that this is a very complex tax law. The application of it is really tough, difficult, right? And you could imagine that if you have a headquarter in Thailand, operations in 30 countries, I would say that it is very difficult if you're going to prepare the QDMDT tax computation, the income inclusion calculation in Thailand using Excel, the basic manual Excel, right? It's not impossible, but it's going to be difficult, and there is a big tendency that you may miss out things, right? So the question then people are focusing on a computation for your tax provisioning purposes, for your IS-12 purposes, for your real actual filing, in 18 months' time, for example. The question is, what options do, taxpayers or M&E has, right? Obviously, there are a couple of options before that. But before I get to the options, I just want to remind everyone, the audience here, you are from M&E, and, I think sometimes you just don't want to jump into, how do you want to automate or how do you want to semi-automate, your solution, so to calculate the calculation. One should take one step back and learn how to walk before you run, right? Go back to the very basic of Pillar 2. Work with your advisor, do some high-level impact assessment as part of the educational process to know your group situation, right? Understand the rules yourself, right? Once you have gotten all that, get proper technical training, workshop on Pillar 2. Once you have all those basics, right? Then you can consider, moving forward, how do I meet my compliance obligation? Now, there are a couple of options that people have. For example, if you're huge M&Es, you have a very robust IT team together the tax team, you of course may want to look at your own accounting system and try to configure that to be Pillar 2 compliant. Well, that is very difficult, but there are one or two multinationals in the world, the big one, who's trying to do that, but generally that is quite a very big task and not really a preferred approach. But there is one option: build your own, configure your own accounting system to be Pillar 2 compliant, but a lot of costs, a lot of resources needed. Of course, option number 2 is to look around, right? Look around and then says, well, are there any third-party service provider that provides the calculation engine for Pillar 2? The answer is yes. Of course, there are a number in the market as well. It's up to you, for one to kind of assess which is the best solution. So you try to integrate that third-party calculation engine into your accounting system, do the mapping, and then you're hoping that, most of the calculations for Pillar 2 can be in a way automated. Of course, it comes with costs, resources, but something that you could consider. Then the other options is really what we call managed services, right? Managed services. Why people do consider managed services around the world. They do consider managed services essentially is outsourcing the Pillar 2 compliance services to your accounting to your professional firms. That's how you do for your normal global tax compliance. Why some people say, yeah, we really go for automation, but some people say, hang on, let's not jump into that. Let's take one step back and say, let's see how the Pillar 2 evolve, right? And the rules are still changing around the world. So why not let the rules stabilize around the world? Then only we do automation in the second year or third year or in the fourth year. So meanwhile, first year, second year, right, for your purpose of provisioning, annual reporting, IS-12 disclosure, and your first few filings, people may consider managed services, in a way. Throw the problem to the advisor. Let them do the work. You provide them information. I'm sure, the advisor, the accounting firm will be able to, use their own tool to calculate that figures for you, right? So what I'm trying to say is that some, depending on your appetite, some people say let's go automation from day one. Some say let's do semi-automation, and the other type is maybe we just settle for outsourcing for the first 2 years. In the third year, we will consider automation. So different MNEs have different appetite for this. If you ask me what is the best, no cookie cutter approach here. Really depends on your, how what's the level in terms of your budget, resources required, and also generally the cost to implement this as well. So all in all, there are many options for the clients. But my advice to all the MNEs, whether you are Thailand-based MNEs or foreign-based MNEs having subsidiaries in Thailand, don't need to jump into automation immediately. You can, but not necessary that is the only option. You should consider various options that you have before you spend time on automation, right? Of course, ladies and gentlemen, people says, in US we have a new government, will at all Pillar 2 will vanish in the thin air in the next few years. I do not know. I don't have the answers for that. But what we know currently at the moment, Pillar 2, global minimum tax, is here to stay, right? For another, X number of years before, new things comes in. But for the next 3, 4, 5 years, you can expect Pillar 2 is going to be part and parcel of the global tax system, right? Thongkoon. Yeah.
Thank you very much, Mr. Hooi Beng Tan. Very interesting on your sharing. I think Mr. Jason will have anything for sharing. Would you like to add anything, Mr. Jason?
Thank you. I think Hooi Beng Tan has covered most of what I would want to say about that. Yeah, take your time, make a sensible decision. It says on the slide, what is the most appropriate approach. There isn't going to be a perfect approach for anyone because this will be expensive however you do it. And the important thing to remember about automation is that, like with any computerized system, any digitalized process, it needs stable rules because every time the rules change, you have to change that system. And reliance on professional advisors gives you a little bit more flexibility because, they have to change their system, but they're changing it once for 100 clients. So until we get, as the rules become more stable, as they become more fixed, so automation probably becomes more attractive to more businesses. But it's about choosing the most appropriate approach for each business, where they're at, which countries they operate in, and that's going to change over time. Which countries have what rules, which may also change over time. And just to agree with this idea that, some people are suggesting Pillar 2 might disappear. Now, the design of it has been deliberately created so that you don't need everybody to sign up to it for it to work. You just need a critical mass. We have that critical mass. They're not going to abandon it now because it does, that would be expensive and difficult to support politically. But it is underlying the position on all this is something that governments want to try and sign up to. So, yeah, Pillar 2 is here to stay for at least long enough that you have to do something about it. And certainly consider automation, implementing the whole thing from the ground up as we have a little more stability. We know the lead time on big software changes in large businesses, we're measuring it in many months into years. If there's a risk that the rules are going to change in less than that time frame, probably it's not the most appropriate response. But yeah, case by case, no, to use the same phrase, there's no cookie cutter approach to this, unfortunately.
Okay, thank you very much, Mr. Jason, for your sharing. Okay, we have the final question now. The final question is, what advice do you have for firms looking to establish or improve their communication with tax authorities during this transition? What best practice has emerged from previous implementations? This question will start with Mr. Hooi Beng Tan.
Thank you, Khun Thongkoon. Again, let me share with you in reality what has happened over the last 24 to 36 months in various countries. Just a little bit recap in ACA itself, Southeast Asia itself. Where are we exactly? We don't have to look far, but just look at Southeast Asia. So Thailand is 2025, yeah. Malaysia is 2025. Singapore is 2025. Vietnam is 2024. Indonesia, I expect it to be in 2025, sorry. And then Philippines, I'm sure there will be announcements soon. So that's kind of sum up the Southeast Asia situation in terms of implementation of Pillar 2. Now, taking a cue from there, why we ask ourselves why effective communication between the firm, means here the tax advisor, and also add on the between the tax advisor and the multinational enterprise, right, with the tax authorities. Why is it important? It's important for one simple reason, because as I said earlier, these rules are complex, new rules, complex, very super complex. So the interpretation of it, right, is a big challenge. Okay, it's a big challenge. That's why you have various administrative guidance which try to help you to interpret that, give it some example, but more to come. So effective communication is to address, among others, the technical interpretation. That's point number one. That's important. But to be fair to the government of the jurisdiction that will be implementing or have implemented Pillar 2 in ACA and around the world, we have to take cognizance that they are not expert in Pillar 2 as well, because these rules are new. So to give them some space, the tax authorities themselves, they have definitely good knowledge, but certain things they may not be sure as well, because this is something new, right? And therefore, the only person that probably can answer, have ultimate answer to this is probably the OECD itself, the one who came up with the rules, right? So now multinationals, yeah, tax advisors like myself, we can't write to OECD, right? We write because the OECD wouldn't have time to entertain all of us. Imagine if OECD starts to entertain every taxpayer in the world, right? Every tax advisor in the world, then they'll be in trouble, right? So therefore, the inland revenue or the Ministry of Finance of the jurisdiction that has signed up on this inclusive framework, they do have constant communication with OECD and a very good relationship with OECD. So that therefore we Mr. Tax Advisor and the taxpayer itself, you have ambiguity with the tax law in regards to Pillar 2. The first port of call is really to get to the tax authorities, engage with them from time to time through professional firms, for example, or directly the inland revenue of every country, including inland revenue of Thailand, right? And then if they have the answers, they will be able to tell. If they are not sure, they will definitely get back to OECD, and OECD will give them a proper answer, and they can confidently tell us the answer. So this is my experience so far. Very important to have a constant, continuous engagement with the government. So you must have that. Sometimes do through professional bodies, right? So that's what one should do, that during the transition period, because I have to admit, the rules are complex. At times, I lost sleep over the rules because it is difficult. And of course, Niorn and I, we are in a global firm, so we have a big advantage in the sense that, of course, we have been always discussing with our global team, the technical team on Pillar 2, so that we have some position taken, not a problem, but sometimes you just want to get confirmation from OECD through the IRB of your country. That is always possible. So communication needs to improve on that. And other advantage of having this good communication with your Inland Revenue of every country is that, do remember, if any MNEs have acted in good faith, trying to implement, trying to meet the compliance obligation, you have done your best, you acted in good faith, trying to understand all these rules. The OECD also have suggested in time to come, during the filing, if there's an error, certain relaxation could be given if you have acted in good faith. So all these are important. Communication, acting in good faith to be 100% compliant. No one can be 100% compliant, that's for sure. So, but at least you have acted in good faith. I think the Inland Revenue Board of every country, hopefully, if not all, most, will kind of give some relaxation to the MNE. Yeah. So that's my input. Yeah.
Thank you very much, Kun Hooi Beng Tan. For wrap up, you are answering communication is key success to overcome the complexity of Pillar 2. Even the Revenue Department officer are not expert in the new regulation. So what they do is talking to regulation issuer, OECD, the professional firms should tackle the ambiguity by talking to the inland revenues, as well as difficult questions can be raised to OECD for clarity. Thank you very much, Mr. Hooi Beng Tan. Okay, let's go to Mr. Jason for closing. We will close Mr. Jason.
Thank you. And again, I think I've been in full agreement with everything that Hooi Beng Tan has said about, talking to your tax authority, getting confirmation as soon as you can. And of course, there has been dialogue with OECD, and there is a formal route for business to engage with the OECD, which is through business at OECD, or as some people may still know it, BIAC, the Business and Industry Advisory Committee to the OECD. There have, I think, been concerns that maybe the communication hasn't been as clear sometimes as they would have hoped on that, and there's been a worry that sometimes the voice of business hasn't got through directly, which is why we've ended up with some of the complexity we've got. But that just reinforces the importance of speaking to the tax authorities and speaking to other people in government who will also be in communication with the OECD. So we know the FTA Forum for Tax Administration recognises the difficulty and the complexity of this, and they're sympathetic to trying to ease the burden on everyone. The more evidence that they have that they can take to OECD to explain about this, the more likelihood we have of getting simpler, more stable results in the long run. But I think we have a question from the audience as well. So do we need to make time to address that quickly now?
Okay, thank you very much, Mr. Jason, for your sharing. We have some question in the comment. Yes, we will pick up for answering. The question is that, okay, it's on the monitor right now. Okay, regarding to the recommendation on the application of the income tax method on deferred tax, and how should this enterprise balance the benefits of BOI incentive with the requirements of TFRS for non-PAEs to ensure compliance and optimal tax planning? This question, I think Kun Niorn may answer. Shall answer this question. Let's go, Kun Niorn.
Okay, so for these questions, I would like to address that right now in Thailand, the regulations might not be obviously clear at the moment because, as you know, the emergency decree just approved last week. So meaning that we will have a clear picture maybe early next year. So at the moment, so please keep update on the regulations that will be officially announced by the Thai Revenue Department. And I believe that in the next EP3 to be organized in March this next year, there will be some, clear on the regulation in Thailand.
Thank you very much.
I can just add on. This is an important question. So based on the latest for Kun Niorn, the emergency decree last week. So nothing has been mentioned about which accounting standard is to be used for Thai QDMTD. Am I right, Kun Niorn?
Yeah, that's right, Hooi Beng. There is no specific requirement on that.
Yeah, so essentially, Thai could end up in only one situation, whether in the, for example, Thai subsidiaries of a foreign multinationals or Thai subsidiaries of the Thai-based multinationals, right? They only have two choices, right? One, to calculate the QDMTD based on UP accounting standard, right? Or based on local accounting standard, which is your Thai accounting standard. So I think that will be a starting point of analysis of these questions. And of course, to add on a little bit more, how do you balance the benefit of BI incentive? That is why the Thai government give you an options of, either continue what you have, 0% tax holiday for the remaining years, or you pay 10% corporate tax, which is half of Thailand corporate tax, but you extend your remaining period of tax holiday to extend it. So the question is then, should you go for that option or should you remain status quo? I think only when you have done your number crunching, right? And then you can really say for sure whether you should, continue the BOI status quo, or you kind of like, I pay 10%, but I double up my extended period. So it really depends on the number. So I think one ought to really run through the numbers. Yeah.
Mr. Jason, okay. Let's go, Niorn.
Clear from Hooi Beng that whether the company will choose to go with the option that offered by the BOI to reduce the corporate income tax rate or go with the exemption is not depend on the position per entity basis, like I said, because pillar 2 we consider the overall jurisdictional ETR, so meaning that the group may need to assess preliminary assess if it is any possibility that you will go below ETR of 15%. If not, then individual entity may go with the exemption scheme. Yeah.
Okay, thank you very much, Kun Niorn and Mr. Hooi Beng Tan for this question. Mr. Jason, would you like to add anything on this question?
I mean, obviously, I'm in no way an expert on Thai law, but it does highlight the importance of looking at the jurisdictional level and how different this is to existing tax provisions, and the change in mindset to make sure that we think through the options and consider the rules as they've been written and implemented.
Okay, thank you very much, Mr. Jason, for your sharing. I must say today's topic has been incredibly interesting, and I'm sure many of you have gained valuable insight. On behalf of the Thai Federation of Accounting Professions, I would like to extend our heartfelt thanks to Kun Niorn Yukolthong, Tax Director at Deloitte Touche Tohmatsu Jaiyos Advisory Company Limited, Mr. Jason Piper, Head of Tax and Business Law, Policy and Insights ACCA, Mr. Hooi Beng Tan, Deputy Managing Director and Southeast Asia International Tax Leader at Deloitte. Once again, we hope to have you share your expertise with us in the future. Thank you very much. Don't forget, for our audience, we have 3 episodes in the Pillar 2 Paradigm Shift, Navigating the Global Minimum Tax for Thai Multinationals. And you can look forward to upcoming episode 3. Thank you very much for joining us today. We would like to say goodbye for now and see you next time. สวัสดีครับ
ถือว่าเราก็ดีใจที่เรายังมีโอกาสได้ช่วยมา แล้วเราก็ได้เห็นผลสำเร็จของสภาวิชาชีพบัญชีนะ20 ปีที่ผ่านมาเนี่ยเราก็เห็นผลสำเร็จเห็นความก้าวหน้าเห็นการพัฒนาการของสภาวิชาชีพได้เป็นสาระสำคัญหนึ่งสมาคมนักบัญชีรายนี้ตั้งมาแล้วมากกว่า20 ปีแน่ก็ถือว่าเป็นสมาคมที่มีชื่อเสียงสมาคมหนึ่งในประเทศไทยทุกวันนี้แล้วก็จะอยู่ยืนยงต่อไปอย่างเช่นปัจจุบันนี้
เมื่อเห็นว่าสภาวิชาชีพของเรามีความเจริญเติบโตก้าวหน้าจนถึงวันนี้ครบ20 ปีแล้วเนี่ยนะครับก็ยิ่งทำให้เกิดความซาบซึ้งชื่นชมยินดียิ่งขึ้นไปไม่รู้กี่เท่า
ในโอกาสครบรอบ 20 ปีนะครับก็ขอให้สภาเนี่ยนะครับมีการเรียนรู้อย่างต่อเนื่องที่จะปรับตัวให้เข้ากับยุคสมัยเข้ากับความสลับซับซ้อนของธุรกิจนะครับจนกระทั่งเป็นที่ไว้วางใจของลูกค้าและผู้ใช้งบการเงินนะต่อไปขอบคุณครับ
สภาวิชาชีพบัญชีกำลังจะครบรอบ 20 ปีผมโดยส่วนตัวแล้วมีความยินดีแล้วก็รู้สึกดีใจมากที่ได้เป็นคนหนึ่งที่มีส่วนในการช่วยแล้วก็ร่วมกับผู้ประกอบวิชาชีพต่างๆในการผลักดันมาตรฐานวิชาชีพของประเทศเราให้ไปสู่ในแนวหน้าแล้วก็อยู่ในระดับสากล
ผมก็มีความยินดีนะครับแล้วก็มีความภูมิใจเป็นอย่างมากนะครับที่ได้เป็นส่วนหนึ่งในการขับเคลื่อนสภาวิชาชีพบัญชีให้มีความเจริญรุ่งเรืองนะครับแล้วก็เป็นที่พึ่งของภาคธุรกิจของประเทศไทยต่อไป
ครับในโอกาสอันดีในวาระสภาวิชาชีพบัญชีในพระบรมราชูปถัมภ์ครบรอบ 20 ปีในปีนี้ก็อยากจะเห็นความเติบโตของสภาวิชาชีพบัญชีให้เติบโตยิ่งขึ้นไปและเป็นที่ยึดเหนี่ยวของผู้ประกอบวิชาชีพบัญชี
ในโอกาสครบรอบ 20 ปีของสภาวิชาชีพในครั้งนี้นั้นก็ถือว่าเป็นหมุดหมายที่มีความสำคัญอย่างมากในการที่เราจะก้าวเดินต่อไปกันในอนาคตพวกเราหวังเป็นอย่างยิ่งนะครับว่าสภาวิชาชีพจะมีโอกาสได้ฉลอง30 ปี40 ปีแล้วก็ไปเรื่อยๆเพราะความยั่งยืนของสภาวิชาชีพของเราในการที่จะทนุบำรุงและจัดวงความรู้ให้กับสมาชิกและผู้ประกอบวิชาชีพโดยรวมในอนาคตผมเองก็หวังว่าความเจริญก้าวหน้าเหล่านั้นจะเป็นประโยชน์ต่อประเทศชาติโดยรวมต่อไป